Welcome to our lecture on Foreign Direct Investment, or FDI, a critical concept in global economics. FDI refers to cross-border investment, where an investor from one country acquires at least 10% ownership in an enterprise located in another country, distinguishing it from passive portfolio investment. This type of investment is a core driver of globalization, integrating national economies into global production networks by facilitating capital, technology, and skills across borders. FDI holds broad macroeconomic, microeconomic, and strategic importance, injecting long-term capital, fostering technology diffusion, and creating employment. From a corporate perspective, companies undertake FDI for strategic motivations such as market seeking, aiming to access new consumer markets and increase global sales. They also engage in resource seeking to secure raw materials, energy, or specialized labor, and efficiency seeking to optimize global production through lower costs. Strategic asset seeking involves acquiring brands, technologies, or R&D capabilities, while risk diversification helps reduce exposure to domestic economic cycles. For multinational corporations, FDI offers pros like greater global presence and competitiveness, expanded revenue sources, and lower production and labor costs. It also enhances supply chain integration and provides access to skilled labor pools, or natural resources, boosting overall efficiency. However, corporations face cons such as exposure to political instability and regulatory uncertainty, increasing managerial complexity due to cultural and linguistic barriers. Other challenges include significant upfront investment requirements, currency risk affecting earnings repatriation, and potential reputational risks, especially in sensitive industries. From the host country perspective, FDI is actively sought for its development-enhancing impacts, including economic development and job creation. It also brings infrastructure investment, technology and knowledge transfer, global integration, and generates crucial tax revenues. Conversely, host countries may restrict FDI due to concerns over loss of sovereignty, where foreign investors gain control of strategic sectors. Other reasons include market dominance by large MNCs, profit repatriation, weakening the balance of payments, and national security concerns in sensitive industries. Environmental or social concerns, such as resource exploitation or poor labor conditions, also lead to restrictions, as countries balance openness with protection. Privatization, the transfer of state-owned enterprises to private ownership, became widespread from the 1980s, often attracting FDI. Countries privatized to improve efficiency, reduce fiscal burdens, raise government revenue, and encourage competition and innovation. This process also attracts FDI and is often part of broader structural reform programs supported by international organizations. Let's look at some real-world examples of significant FDI in the U.S., starting with Toyota Motor Corporation's manufacturing investments since the 1980s. Toyota has invested over $40 billion, employing more than 40,000 U.S. workers directly and supporting over 160,000 jobs through suppliers and dealerships. Samsung Electronics semiconductor and battery investments in Texas, including a new $17 billion plant, represent one of the largest single FDI projects in U.S. history. These investments support U.S. semiconductor supply chain resilience, create high-tech jobs, and expand domestic production of critical chips. German conglomerate Siemens has made multi-sector industrial investments in the U.S. for over a century, contributing to energy, transportation, and medical technology. Honda Motor Company's FDI in Ohio since 1982 has created over 30,000 U.S. manufacturing and retail jobs, fundamentally changing U.S. automotive competitiveness. Finally, UK-based Shell's investments in the U.S. energy sector, totaling over $80 billion, anchor major U.S. petrochemical and energy clusters. For further research, valuable FDI resources include data from the U.S. BEA, ITA, and Federal Reserve, as well as reports from UNCTAD, WTO, and JETRO. In conclusion, FDI is a powerful force driving globalization and economic development, balancing significant benefits like growth and technology transfer with potential risks.